The mid-cap index continues to outperform the key indices because the mid-cap index is up around 25 points and names like NHPC, Tata Elxsi, Arvind as well as Vodafone Idea moving higher in trade. But let's move on. Radhika Rao, the economist at DBS Bank, joins us on the show to get a sense on the economic outlook ahead of elections. Radhika, good afternoon. Thank you so much for joining us. Bond markets have eased as tensions between India and Pakistan have settled. What is your sense on the 10-year now? Are we out of the woods?
Certainly, I think the geopolitical tensions between the border tensions particularly had driven the 10-year yields beyond 7.65% on the old paper. So after this have eased, it's pulled back. But I think then we come down to the routine factors that have been affecting the bond yield or the bond markets in the past few months. So I think those familiar problems still remain, which suggests to us that the 7.5% will be like a near-time support for the 10-year. So I think we have to keep an eye on the currency in circulation. Basically, there's a lot of leakage there. Currency in circulation has been going up, which has been strapping liquidity on one hand. On the other hand, the central bank has also maintained its interventionist bias, especially when rupee goes through bouts of weakness. So amidst when this is happening, of course, the central bank has been, I think, a very important player in the bond market in whole of fiscal 19 in terms of stepping up OMOs, including March purchases. There's going to be almost 2.93 trillion worth of bond buys. So that has helped keep cap on the 10-year. But I don't think beyond that, with foreign investors still on the sell mode, and you've got this familiar reasons, the currency circulation, you've got intervention, you've got oil prices that have bounced off lows. These seem to suggest that the 10-year have found a floor at 7.5%.
Okay, so 10-year has found a floor at 7.5. But Radhika, what is your expectation on the bond markets in the near term, considering that March is expected to be tight on liquidity due to year-end factors?
Certainly, I think typically because March marks the end quarter as well as the end fiscal year, and you will see short-term rates, especially call money rates, behave pretty volatility is usually very high in these interbank rates as in this particular month, and especially when we head towards the end of the month. I think to get over that, the central bank usually, takes a lot of proactive steps. I think this time around you've seen them really jumpstart OMOs. For the first fortnight itself, the central bank has already made announcements. For the second part of the month as well, we expect more term repo support and more bond buybacks, as well as other liquidity measures, not durable, but short ad hoc liquidity support, which will make sure that the systemic liquidity as well as the banking system liquidity stays supportive, especially for credit, and rates don't really blow up. But you would see a certain amount of strain, and that is pretty much factored into the price action. But I think thankfully, because of proactive action by the authorities, we don't think there'll be a long-lasting impact on the bond markets and particularly the yields.
So Radhika, what would be the near-term range for the 10-year in the given next 3 to 6 months?
So I would think the 10-year would be in the 7.5 to 7.6 in the old paper, and the new one, which is now the generic, would be 7.3 to 7.4. So then it has been pretty range bound. I think if not for the central bank's support, given what's happening domestically, and as we head into the election as well, I think the 10-year bond yields would have raced higher. But I think because we have a big buyer in the market, I would think that it would be more range-bound action with a slight upside bias.
Radhika, what are your estimates on the fisc, growth, inflation, etc. ahead of elections?
So I think for growth, we recently saw the December quarter numbers come out, and it was largely in line with our expectations. But what that's telling us is that the growth engines are actually running at differing speeds. So you've got investment, which seems to still suggest that there was some momentum left, but consumption is clearly stalling. So you've got, and that I think crystallizes down to, you've got rural growth. I think it's widely known now that the rural sector incomes as well as returns on crops have not been doing very well. In fact, the nominal agricultural growth is pointing towards very low returns overall, in terms of income levels. So there's slowing consumption, investment did fairly okay, but given base effects, given this differing speeds of growth drivers, we think that the March 19 as well as June 19 growth numbers are going to be sub 6.5%. So I would think it's a 6 to 6.5 kind of range for these 2 quarters, and thereafter you would try and begin to see a slight improvement, where then you would see consumption improve a bit because you're seeing financial conditions. The central bank has started easing rates. You would see that help. Oil prices have also come off where they were last year, and you also see some of the budgetary measures that will take effect help in the second part of fiscal 20. And overall, like we said in the event study, we also expect the private sector to come back to the fore. So given these factors, we think that in the second half of fiscal 20, growth will look slightly better. But certainly in the very short term, this quarter that we are in, as well as the next quarter, I think growth numbers will be in the range of 6 to 6.5%.
Radhika, in that context, what is your expectation from the RBI in the next policy?
Sure. So beyond the February meeting, I think February meeting review was important, particularly to us, because it was the first time that you would hear Governor Das, elaborate on how the panel as well as he see the inflation. And I think the messaging, the communication was fairly clear that much attention is on the headline inflation, and then if the headline inflation permits, that the central bank would and the panel would take a growth supportive role. Now, given this as your central premise, I think an April cut is a given to us. But beyond that as well, I think the odds for rate cuts are rising, particularly because inflation continues to surprise on the downside. And I think from here it will still, I think probably Jan was probably the bottom. You would see inflation edge up from current levels. But I think if it keeps, which I think it will, but it keeps below 3%, then I think the central bank still has the room to go ahead and cut rates. And in the regions, the RBI has set the ball rolling in terms of easing rates, because given in favorable inflation dynamics and the need for growth and the real rates cushion in terms of where your repo rate is and versus where your where your repo rate is as against where inflation is, there is sufficient cushion for the central bank to go ahead and cut rates. So April seems to be a given to us, but beyond that as well, I think the odds for certain more rate cuts, probably 1 or 2 at best, are certainly on the rise.
Okay, so ample room for the RBI to cut rates in the April policy. Thank you, Radhika, for joining us with that perspective. But with that, it's time now for a short break on the show. Up next, we get you some F&O strategies from CA Rudramurthy of Vachna Investments. Stay tuned for that.